Hi, welcome back to the video. This video is part 2 for your chapter 4 video. So in this session, you are going to learn how to record the transaction when the company issues ordinary share. Company first issues ordinary share when they are created, but they will decided to issue share after the incorporation or expansion of any other purposes. Issuance of share can be a channel for company to raise funds. So there are some terms that you have to take note when you record the issuance of share. The first one, par value or nominal value. This is the original value of the share in the company books. Next, issue price. This is the amount that a company collect from shareholders who subscribe the company's share. Next one, premium. Premium is the difference between the issue price and par value. The excess amount will be treated as share premium in the statement of financial statement. So basically, we can say that premium equals to issue price minus par value. So we use one example to practice the accounting of issuance of share. Classroom exercise 1.4. So I use the whiteboard for a better presentation. Classroom exercise 4.1. TCP Limited has issued 400,000 ordinary share to public at the amount of $1.30 each. The par value of the ordinary share is 1 each. So from here we write down the things that we know. So first one, we can indicate what is the issue price. The issue price is 130. The par value is 1. So the premium, the share premium is how much? Is 30 cents per share. You see the formula again. Premium equals to issue price minus par value. Issue price minus par value, we get premium. So basically, issue price is the highest amount. So we use the issue price minus par value, we can get the premium. So now we have to record this transaction. So first, debit will be the bank account to record the amount received. Next, we will credit to ordinary share capital account. Next one, we credit to share premium. So how much for debit? We use 400,000 times 1.3. We get 520. We use calculator to check this. 400,000 times 1.3, 520. And for ordinary share, we use 400,000 times the par value 1, which is 400,000. And then for share premium, we use 400,000 times 0.3, which is the premium. So we get 120,000. So this is the double entry when we issue the share for the company. And take note, for ordinary share, we only record the par value of the share that we issue. For share premium, we record the premium that we collect from the issuance of share. The ordinary share and share premium must be split accordingly when the company issues shares. So let's take a look on next example. LKY Limited decided to issue 500,000 units of 50-cent ordinary share to public, the price of 70 each. So from here, we can know that the issue price is 70 cents because this is the amount that they sell to public. Par value of the share is 50 cents each. So So the difference between your issue price and par value will be your premium. And for this example, premium is 20 cents each. So let's take in the double entry. We debit bank account because we will receive money. We credit to ordinary share. And we credit to share premium account. So how much to collect? For bank, we sell 500,000 share. We sell 70 cents each. So we get 350,000. For ordinary share, we sell 500,000 share. The par value of each share is 50 cents. So we get 250. And for share premium, we sell 500,000 share. Each share we get 20 cents of the premium, which is this one. So we get 100,000. So this is the accounting entry that you need to record when the company issues shares. And take note, if the company issues price equals to par value, it means that you will not have premium. The issue price can be equals to par value. If your issue price equals to your par value, it means that no premium in the account. So next, the next section, I'm going to discuss the accounting of right issue with you. So what is right issues? Right issues is the issues of additional or new share for the existing shareholder of the company. The company raise additional capital via right issues, and shareholders can subscribe to the newly issued share in proportion of their current holdings. The purpose of the right issues is preliminary to raise fresh capital for corporate expansion or a takeover. This practice is also resorted to by a company to prevent any likelihood of being conned out. Preliminary equity capitals and market capitalization of the company get affected with the right issues. The issue of fresh equity raise equity capital of the company, while change in market capitalization is as perceived by the market. Also, right issue gives the company better leveraging opportunity if shareholder does not subscribe the percentage of its shareholding comes down after the issues. Also, he or she can sell the rights as the rights are generally tradable, or they can simply ignore and let the rights issues lapse. So what is right issues? Right issues basically is sell share to existing owner. You sell the company share to existing owner. It means that the owner, the current owner in the company. So what is the advantages of right issues? As right issues is issuing share to its existing shareholders, it will not have a less chance of losing control of company. Next one, company can save costs in advertising the right issues as the existing shareholders will be notified. The disadvantages of right issues: it may be difficult for company to raise funds from existing shareholder if the company's performance is not good. Let's say you invest in one company and the company want you to buy the share again. If you know that the company is not performing well, you may not take the right issues, right? Next one, dilution of shareholding if the shareholder do not take up the right issues. Normally, right issues will give to the shareholder based on their percentage of shareholding in the company. Let's say the company, the owner, they have a rights, because we call right issues. They have the rights to buy the share, or they can choose not to buy the share. So if they do not buy the share and other shareholder buy the share, their percentage of shareholding in the company will reduce. So let's take this example for right issues. Classroom exercise 4.3. YJ1 Limited has 500 ordinary shares at the par value of 50 cents each. the management decides to write issues to existing shareholder at the basis of 1 share for every 4 existing share held at a price of 80 cents. The right issues are fully subscribed. So let me give you some introduction of this question. It says that YJY currently they have 500,000 ordinary share and the par value is 50 cents each. So management say that they offer right issues to their existing shareholder. If you have 4 shares in the company, you can take 1 share. If you have 4 shares in the company, you can take 1 right issues. So how much the company sell the share? They sell at 80 cents. And here, the right issues are fully subscribed. It means that all the shareholders in the company, they agree or they want to take the right issues. It means that 100% subscription. So before we account the double entry, we have to consider how much of the right issues for this company. So the company originally having 500,000 ordinary share, and the right issues is on the basis that if you have 4 shares, you can take 1. And this right issues is being fully taken off, so it's 100% subscription. So the number of shares is 500,000 divided by 4, 125,000. It means that the number of right issue is 125,000. So after you know how many shares or how many right issues in this period, we have to calculate the accounting entry. So this accounting entry will be similar to what we learned in the exercise 4.1 and 4.2. First, we identify what is the issue price. We identify the par value, and we determine whether there is any premium on the issuance of share. Issue price 80 cents, par value 50 cents, so the premium will be 30 cents. We use 80 cents minus 50 cents, so we get 30 cents. Alright, next we have to pass the double entry. So when we sell share, we receive the money, so we debit bank account and we credit to ordinary share capital account, and we credit to share premium account. But how much we receive? For collection, we sell 125,000 share. Each share we get 80 cents. So this is the issue price. So we use 125,000 times 80 cents. So we get 100,000. So 100,000 is the amount that we receive. So how much we receive as ordinary share? We use 125,000 times 50 cents. And for share premium, we use 125,000 times the 30 cents. So ordinary share, let's see how much we receive. 125,000 times 50 cents, 62,500. So 62,500 for ordinary share, and 37,500 for the share premium. So this is the accounting entry for right issues. Next, I'm going to share with you what is the changes before and after right issue. So we start from before right issues. Before right issues, the company is having 500,000 numbers of share. The ordinary share value, we use 500,000 times the par value, which is 50 cents each. The value in dollar, can you see? This one is dollar, this one is unit. In dollar is 250,000. So the value of share premium is silenced in the exercise, so we put dash. The total value is 250,000. So right issues, So during the right issues, we right issues 125,000 of share. The value dollar in ordinary share will increase 62,500. For share premium, we increase 37,500. So the total value increase will be 100,000. How to get 100,000? I use 62,500 plus 37,500. And next, after right issues, my number of share increased to 625,000. My ordinary share capital value increased to 312,500. Share premium 37,500, and finally the total equity of the company is 350,000. So from here we can see that this one and this one, the company equity increased from 250,000 to 350,000. So it means that the value of the company increase, the equity or the net worth of the company increase after the right issues. So this is the explanation of right issues. And we have one more exercise, 4.4. This classroom exercise 4.4 I will discuss with you in our live section. And that's all for our part 2 video. In the part 3 video, I will explain to you how to account when the company have bonus issue and what is the accounting treatment for dividend. So that's all for the video. Thanks for watching.